And this is Bloomberg Technology. Coming up in the next hour, Apple stock falls the most in 6 years after the bombshell news. It cut its revenue outlook for the first time in 2 decades. China is in focus. Apple has become the latest and biggest corporate casualty of the pullback by the Chinese consumer. And the company says the trade war hasn't helped. But is this just a China problem or an iPhone problem? And will the rest of big tech get dragged down with it? And Tim Cook's leadership called into question. The Apple CEO now faces his biggest test since taking over. First to our top story, the shocking letter from Tim Cook to shareholders. Apple cutting its revenue outlook for the first time in 2 decades, citing weaker demand in China amid the ongoing trade war with the United States. Apple dropped a big hint that iPhone sales were sagging back in November with a decision to stop reporting unit sales. Here's a take on some of what we've seen on Bloomberg Television.
They will still hit an all-time high in earnings per share this quarter. So profits per share are still going to be better than ever, even though revenue will decline for the first time in a long time. And unexpectedly, they've hit a real speed bump in China and with the iPhone.
People who've been watching Apple closely for a long time, like I have, and many others, have known that the wall was going to hit at some point. And it's just hit in a harsher way than I think people expected.
Clearly, henceforth, corporate earnings and what corporates say about China and economic data, PMI numbers, growth numbers, retail sales, industrial production, you name it, the slew. Markets will be very sensitive to this data.
I think you are seeing that idea that emerging markets, and particularly China, is slowing faster than forecasted, that maybe actual GDP is much, much lower than what they normally tell you.
It's not alarming to me, but it could be alarming for those, I think, maybe, who are calculating stock prices or forecasting what volume is going to be.
We come up with a $240 target price. It may not necessarily get there in the next 6 to 12 months, but we do think that's the real underlying value of the Apple stock.
Dan Ives, Managing Director at Wedbush Securities, and Bloomberg Tech's Mark Gurman, who covers Apple, join us now to weigh in. Dan, you said that Apple fell off a cliff in China. How did that happen, and how did Apple not see it?
Look, that's the really question investors are trying to understand today. I mean, look, this was the darkest day for Cook and Apple in the modern iPhone era. And I think it was jaw-dropping that they did not really see this demand fall off in such a way they were able to predict. And I think fundamentally it comes down to 80% of this, in our opinion, is an Apple-specific story. They had a pricing hubris, and ultimately you really saw it on 10R in China. And this was, what I would view as an apocalyptic type quarter and a defining moment for Cook going forward.
Apocalyptic quarter, that's a big word. Mark, put this into perspective for us. Give us some numbers. If there's an $8 or $9 billion revenue shortfall, and most of that is in China, what does that mean in terms of how many iPhones weren't sold in China this past quarter?
Well, first of all, I agree completely with Dan. Apple likes to point out these external factors or external forces, as Cook said in an email to employees. But I think, like Dan said, this is at least 80% self-inflicted, having to do with the extraordinarily high stratospheric prices of the latest iPhones. If you look at the pricing of smartphones in China, we did the math on this morning. Some of the high-end phones from Oppo and Huawei cost about half that of an entry-level iPhone XS or XS Max. There's phones from Vivo that cost a quarter of the price, and the iPhone XR is still significantly more expensive than its competition that might still even have better specifications, sharper displays, more features than the XR. So I think this comes down to some sense of hubris, like Dan said, whereas Apple needs to really evaluate what its pricing strategy is. And to answer your question, it's very clear that they missed out on a good chunk of iPhone sales, millions of units this time around that they were expecting to take place in China.
Dan, try to parse for us how much this is due to the pullback of the Chinese consumer, due to a U.S.-China trade war, and due to a smartphone problem in general with a global market that's slowing down and a China market that's slowing down.
Yeah, and look, Cook, you saw it use the macro card China tariffs. And, I'm surprised you didn't cite the weather as well. Fundamentally, this is an Apple-specific pricing issue. I continue to say 80% of it is them mispricing, miscalculating demand, the marketing, as well as the development and ultimately the feature functionality on this latest version. I do think they are seeing headwinds in terms of China consumer, in terms of what you're seeing on the trade wars. But this was really for them a China-specific problem. And I think right now, they have to kind of look in the mirror and realize what they're going to do going forward. Is it pricing cuts? Is it more focused on the services? Is it content? But this is really a fork in the road situation. How they handle this will determine the future of Apple. And ultimately, Cook's legacy rests on what the next 6 to 9 months does in terms of in terms of this product strategy.
Now, I do have a chart here in my GTV library, which shows the revenue breakdown for Apple. Of course, we know the company is trying to become more of a services company. But if you look at the white line, that is iPhone revenue. Still 2/3 of revenue that Apple generates is from the iPhone. So, Mark, how can Apple fix an iPhone problem in China specifically when, the iPhone is their major product?
Yeah, and just one other point to add to what Dan was saying. I'd really like to know where the people who are blaming tariffs for this are getting that information from. The tariffs have not gone into place yet. If they even do go into place, the prices of the iPhone...
Very important point, Mark. You're saying that the iPhone has not changed in price as a result of the trade war, correct? It's still the same price.
It's still the same price, so I'd like to know where that's coming from. Maybe this happened in the last day or so. No, it didn't happen. The prices are the same. And then on the services point, Apple's really wanting to position themselves as a services company over the last year or so. And, the answer, the reason why is what we saw, shake out this week, what we saw shake out over the past few weeks. They want to show investors that they're not a one-trick pony. If the iPhone was selling, through stratospheric levels, you wouldn't see them positioning themselves as a services company like they are doing today. This is what they need to do to show that they're going beyond the phone. The problem is that people point to the iPhone being about 2/3 of sales for Apple. But that's not really true. At the core, it's 2/3 of sales. But what about all the other products that people are talking about? The Apple Watch, the AirPods. You can't buy an Apple Watch or AirPods if you don't have an iPhone. The HomePod people are talking about syncs with the iPhone as well. Even the Mac and the iPad are best used, and those are very small volume products with an iPhone. So it's 2/3 of sales at the beginning, but you add up everything else, it all comes down to the iPhone, including services, right? We saw those astronomical App Store numbers come out from Apple one day after this release about the revenue recalculation. Those App Store sales, where are App Store sales happening? They're happening on the iPhone. So it all comes back to the iPhone. So they have to figure out a way to really keep pumping out the iPhone or create a new hub, the replacement. Remember back originally, the Mac was Apple's hub where everything was built around, right? Then it was the iPod. Now it's the phone. They tried to say it was the cloud, but it's really still the phone. So they either need to get the phone selling well, or they need to find the phone's real successor.
Absolutely. The sales of the App Store, Apple Music, Apple Pay, those are generated mostly on iPhones. Now, I did sit down with Tim Cook in June 2017. This was in the middle of when Apple was seeing some declines in revenue in China. I asked him about it. Take a listen to what he told me then.
China, for us, we make all of our decisions for the long term. And so we're not investing for next quarter or next year. We're thinking about many, many years out. And as I stand back and look at China, I see mega trends there that make China an incredible market. And I don't mean just a market to sell in. I also mean a market for application developers. And so it's an incredible marketplace for talent, and in terms of the size of the marketplace. And so the short-term kinds of economic moves up and down, I don't get too excited about.
Now, after that interview, China did return to growth for Apple for a few quarters. And Dan, my question is, this is still a potentially $84 billion quarter. Is calling it an apocalypse an exaggeration?
Look, I mean, as someone that's covered this story for decades, and obviously Mark knows as well as anyone, this was, in our opinion, clearly the most jaw-dropping miss that we've seen out of Apple really since the company's been public. And I think fundamentally it's because of iPhone. To have an 8% miss on top line, that's iPhone generated at that point, especially given supply chain, how they see demand in terms of in the field. I mean, this is essentially, put in numbers, 25 to 30 million iPhones they thought they originally were going to sell, they're not going to sell. And if you look at that in the scheme of things, that's why it's apocalyptic. Because in terms of them not seeing it, in terms of just how soft China was, and that's 20% of all iPhones that are in the potential for an upgrade opportunity. And I think going forward, they need to make a decision one or two ways. One, cut prices, focus on demand, drive services, have price points and features that are going to drive those upgrades. Two, continue to do the same thing and have the hubris. That's not a good ending. So I think right now, that's why you're seeing the all hands meeting and a fork in the road for Apple.
They do got 3 phones selling for over $1,000. Wedbush analyst Dan Ives, Bloomberg Tech's Mark Gurman, thank you both. We're going to continue to cover this throughout the hour. Meantime, Mark Zuckerberg's multi-billion-dollar stock sales ground to a halt in the last months of 2018. The Facebook founder didn't sell a single share in the fourth quarter when the social media company stock tumbled 20% amid a broader market rout. It's the first period in more than 2 years that he's refrained from doing so, according to data compiled by Bloomberg. Well, the White House's top economic advisor has cautioned more U.S. companies can expect more headwinds due to the slowdown in China. Will the Apple news influence trade negotiations? And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Apple CEO Tim Cook is blaming trade tensions in China for not helping its reduced revenue forecast. And now one of President Trump's economic advisors says there may be more pain to come. Kevin Hassett, the chairman of the White House Council of Economic Advisors, told CNN that it's not going to be just Apple. I think there are a heck of a lot of companies that have a lot of sales in China that are basically going to be watching their earnings be downgraded next year until we get a deal with China. That puts a lot of pressure on China to make a deal. Joining us from Washington, Bloomberg's White House editor, Alex Wayne. So, Alex, does this news from Apple, put more pressure on the president to make a deal or not?
I think there are two ways to look at it. There's the White House way of looking at it, which is that the problem U.S. companies have is that China's economy is slowing down, and the reason China's economy is slowing down is because the tariffs are working. In other words, Trump is winning his trade war. But I'm sure the way that shareholders and the executives of U.S. companies are looking at it is this trade war isn't helping anybody. It's hurting China's economy, which has the effect of hurting us. So I don't know if Kevin Hassett was really on message there today with those remarks.
So any indication of how there's a lot going on in Washington, but any indication of how this news has been received?
Well, investors heard Kevin Hassett say that companies with a big footprint in China are going to be cutting their earnings, and they took his advice. There was a big sell-off of companies with footprints in China today. So, they're being heard, and it's having an effect.
All right, Bloomberg's Alex Wayne joining us from Washington. Thanks so much. So is there more pain to come for the tech sector? To answer that question, I want to bring in Mark Mahaney, analyst with RBC Capital, who covers the FANG stocks outside of Apple and has just published his top 10 internet surprises for this year. So you basically cover every tech stock besides Apple. But do you think this news from Apple will bring down the rest of the tech market?
For those companies that have got exposure with high price points in China, I don't know why this wouldn't be a pretty reasonable read. I don't know how much of this is Apple specific, though. I guess that's the real question: is the Chinese economy slowing down? It seems like that's a pretty broadly understood. Now, I look at the other FANG names. Their exposure to China probably for bad reasons, is actually pretty limited. I think in a long scheme of things, I think they wish they had a lot more exposure to China than they have.
Facebook is blocked in China. Google left China. Twitter is blocked in China.
And
all
Netflix,
your companies.
Yeah, Amazon does have a presence there. Priceline, eBay. There's a few companies that have a presence there, but nobody's got more than mid-single-digit percentage revenue contribution coming from China. So I don't think we'd see it there. We got a high-priced, large exposure company like Apple to China. They're going to see it before anybody else does, and they may only be one of the few people to see it.
Okay, so to get a little bit more detailed, if you actually look at Apple, it's pretty cheap, trading at 11 times earnings, whereas Google 19 times, Facebook 16 times. Are these other companies overvalued, and do you think there will be a reckoning for them because of what's happening in the broader market?
I think we've seen a reckoning already. We've seen a sell-off, especially in Facebook. But I think the unfair, if you will, the oversold situation is probably most acute in names like Google and Amazon, where fundamentals haven't changed at all. There's nobody bringing down estimates on these names. Growth at Google has been extraordinarily consistent. This has grown 35 straight quarters. That's unheralded in financial history at around 23% year over year, and yet the stock is trading at just a small premium to the market. So I think these are unusual secular growth assets. They're scarcity growth assets. I think they provide very good risk-reward opportunities here. I'm not sure this is the best we've ever seen, but this has got to be in the top quartile of buying opportunities.
So was Mark Zuckerberg right not to sell any shares in the last quarter?
Yeah, and what the company is right to do is they announced in the beginning of December that they were going to do a $9 billion extra share buyback authorization. They should absolutely be doing that. Put your money where your mouth is. You've got tons of cash. So does Google, by the way. Both of these companies should be amping up their share repurchases now.
But what about regulation and sentiment?
Yeah.
People hate Facebook right now.
Well, I'm not sure they hate it, but they certainly are in. Look,
there's distrust.
Yes, there
is distrust.
They have to earn it back. By the way, I keep thinking about Netflix. You remember 3 years ago when they had the Quickster fiasco and they tried to cause the prices to they raised prices and they lost subs for 2 quarters. They went through a year or two. The stock did a meltdown a year or two before they regained trust. That's probably.
And then they stopped calling it Quickster.
Yes, but I think that kind of brand, you can damage brands, but they can be fixed. Our survey work has shown declining satisfaction scores for both advertisers and consumers with Facebook. This stuff can be fixed, but it's going to take time. We think it will. And by the way, I think the risk reward is very attractive on Facebook. I get all the controversy around it. I just think that's more than priced into the stock right here.
So where's the reward coming from? I mean, they haven't started monetizing WhatsApp yet. They have started monetizing Instagram, but Instagram, you could argue, has some of the same problems.
Possibly, but I'm sorry. You just quickly went over WhatsApp. Now wait a second. This has got over 1 billion users. There are multiple messaging apps. This is Facebook's advantage is the portfolio that they own. The 2 largest social media assets in the world and the 2 largest messaging applications in the world. The latter 2 are barely monetized. Don't you want to own that asset before they start monetizing? Unless you think they can't structurally be monetized, I don't think that's true. So I think you have a company with a lot of controversy, and they shot themselves. I don't know how many feet people can have, but however many they have, they shot them in all of them. But I think the fundamentals can stabilize in the back half of this year, and I think you buy the stock before the crowd does.
Okay, so let's talk about Netflix, because you say that you're optimistic about subscriber growth.
Yes.
SunTrust is not optimistic about subscriber growth, and we just spoke with John Klein, the president of Ealings, who's the former president of CNN. Take a listen to what he said about Netflix.
Winter is coming for Netflix, in the form of much more competition and a much more expensive operation moving forward. They're going to have to be creating many more original programs moving forward because all of the studios in Hollywood are pulling their movies and TV series off of Netflix. And what Netflix is facing is something that I talked about on this network before, which is they may be the AOL of OTT.
Could Netflix be the AOL of the over-the-top era?
That's a great line. I completely disagree. And the reason is this is a scale game. So whoever has the most subs can afford to buy the most content. That's the point that's missing about this winner argument. There's escape velocity, and Netflix has already reached it. They have 6 times as many paying subscribers as anybody else. That means that whenever the next Fast and Furious 13 comes out, they can economically bid more for it than anybody else can. And by the way, they are now becoming the biggest buyer of content out there. I don't think studios do not want to sell to the biggest buyers because then they'll have to answer to their own shareholders. Netflix, I think, is in the catbird position here.
So what about Amazon and regulation in general, not just as it applies to Amazon, but also Facebook and Google. We know that Congress, we know that Washington is taking a closer look at all of these tech companies.
I don't know if we're at peak, Greg. And look, these assets are so big now, especially Amazon, Facebook, and Google. They should be constantly scrutinized, given the size of the assets.
So you're saying more regulation is coming, peak regulation?
No. Look, we just had 2 massive fines placed against Google in the last 3 years, like $8 to $9 billion.
In Europe, not in the U.S.
Yeah, I don't think you'd see fines in the U.S., but you could see regulation, absolutely. But by the way, did it impact Google's growth rate? No, we haven't seen anything undermine the value proposition of Google for either advertisers or consumers. And by the way, you want to go after Amazon for market share issues? It's half the size of Walmart. So you'd have to first bust up Walmart before you'd want to go to bust up Amazon. And I hope we're not in an economy where we're going to bust up people just because of size. So anyway, I look at Amazon as an extremely innovative, successful company. And by the way, they seem to be much more politically astute than these other companies. I mean, they are the ones that implemented the wage increase. I think they're a little bit savvier and smart in terms of where they position their headquarters, et cetera. So I think the regulatory risk of all these names is probably least likely with Amazon.
So Apple has generally outperformed the broader market. You wonder if that will continue in the midst of this news. Do you think the FANG stocks in general will outperform in 2019?
Yeah,
or not?
Yes, I think that's an out of consensus view. I think people believe that tech is over, FANG is over. I've lived through these cycles before, so have you, Emily. These things can wax and wane. But the fundamentals, if they stay intact, the stocks will come back to reflect the fundamentals. And these are premium growth assets. You can't find this kind of growth anywhere else, this kind of consistency of growth anywhere else. Market will come back to these names.
All right. Mark Mahaney, always good to have you. RBC Capital Markets. We'll have you back many times before the end of the year, but we're going to check you on that at the end of the year, I promise. Okay, coming up, China wants to be one of the top aerospace powers by 2030 and just got a bit closer with its latest milestone. We'll bring you all the details next. This is Bloomberg. Airbnb has won a preliminary ruling that blocks a demand from New York City to share its data. The company will not have to comply with a law requiring them to turn over renter data until a lawsuit over the issue is resolved. The law, set to go into effect February 2nd, threatened to cut Airbnb's bookings in the city by half. Square named Activision Blizzard executive Amrita Ahuja as CFO, replacing Sarah Fryer, who left the digital payments company last month to become CEO of Nextdoor. Ahuja will report to Square CEO Jack Dorsey and says she will help strengthen our discipline as we invest, build, and scale. And it is a first for China and its ambitious space program. The Chinese have landed a lunar probe on the far side of the moon. It is the first ever spacecraft to reach the surface that always faces away from Earth. The nation's space budget is about $8 billion a year, second only to the United States. Coming up, New Street Research's Pierre Ferragu is starting the new year with a new recommendation on Apple, why his outlook has changed for the better next. Plus, why investors are punishing U.S. companies vulnerable to China's slowdown. We will discuss. This is Bloomberg. Chang in San Francisco. Right now, I want to welcome our colleagues from Daybreak Australia and Asia, Sherry Yan in New York, and in Sydney, Heidi Stroud-Watts here to Bloomberg Technology. And first, I want to talk about the global impact of this surprise revenue cut from Apple. Sherry, you've been looking at the U.S. markets. They closed now over an hour ago. Where did they fall?
Yeah, I mean, you saw the semiconductor index and Philadelphia Semi Index, really 29 of the 30 chip makers falling, a really big impact there on concerns over Apple. But of course, U.S. suppliers like Skyworks, Broadcom all fell. Skyworks down more than 10%. But Emily, we have to really expand this story to not only talk about Apple, but also the concerns over this economic slowdown in China, as we see companies like Starbucks, FedEx, all talking about the potential impact as Chinese consumers just buy less. Auto suppliers such as Delphi Technologies also falling. The thing is, JP Morgan releasing a note back in July talking about the biggest China exposure in the U.S. stock market being technology, energy, industrials, consumer staples, and consumer discretionary. Emily, that's a really long list.
It is a long list indeed. Now, we all know going into this that over the last several weeks, several of Apple's suppliers have also cut their revenue forecast. So there were signs that something was amiss. Many of those suppliers, Heidi, are based in Asia, based in China. Asia markets are about to open. What are you watching?
Yeah, Emily, as you say, it's almost a bit of a precursor or a bellwether, right? The fact that we've seen some of these Apple suppliers from Hong Kong to Taipei to Seoul and Tokyo fall as much as 70% over the past year on these fears. Ever since Apple decided that they were going to stop releasing the shipment information, that they were hiding something that was pretty negative about the outlook for iPhone demand. And we did see those declines leading losses in Asia yesterday, likes of Samsung, SK Hynix, LG Display. And just a reminder, this is about a quarter of the overall cost yesterday, so it's no surprise we saw South Korean markets plunge yesterday. Also over in Taiwan, of course, Hong Hai Precision, one of the biggest suppliers for Apple, as well as those that make lens stabilization products over in Hong Kong as well, all falling. Today, Japanese markets come back online, so we're looking at the likes of LG Display, Alps and Sharp as well that make display screens. We are expecting to see that flow-on effect continue today.
All right. I do want to bring in now New Street Research analyst Pierre Ferragu, who has upgraded Apple to neutral from sell. Pierre joining us now from New York. Now, Pierre, we had you on the show when you put that sell rating on Apple, and you said that you believe there was some big bad news coming. Is this what you thought it would be?
Well, if you look at what Apple announced last night and what we could read in Tim Cook's letters to shareholders, that's three things. The first one is that iPhone revenues are likely down 15% and shipments, like units, down 15 to 20%. And then the second thing is, of course, what the color team provided around that. And he talked about two things. The first one is he says that globally, overall, in every country, there was less replacement than what they were expecting. And then the second thing he mentioned is, of course, like a difficult macro environment with a difficult emerging markets, and especially in China. So that's what they said yesterday. And the reason why we had this discussion about Apple a few months ago, Emily, is because what we were anticipating is simply a couple of things. The first one is that globally, everywhere in the world, iPhone users very much like their phone, but they stick to their phones longer. And because they do that, there is pressure, ongoing pressure, year after year on iPhone sales. So that's one thing. And then the second thing is that in 2018, last year, the iPhone X was extremely successful. So a lot of consumers replaced their iPhone for the iPhone X in 2018 and are not in the market anymore in 2019. Right. And that's really what drove most of the weakness in Apple today.
Also less replacement of phones just because they're more expensive. You don't want to continue buying these very expensive phones. So when will we find a floor on this trend?
So yes, I think price plays a big role. It's still difficult, to quantify exactly. But if you look at like the, I would say, archetypical iPhone buyer here in New York, 3 years ago, that consumer would be buying a new iPhone for $700 every year. This very same consumer today is buying an iPhone for $1,000 or more, is buying a pair of earbuds for more than $200, and a watch for $450. And so with all that basket in hand, this consumer is reluctant to come back to the shop the next year. So I think Apple has done a very good job increasing ASPs, getting immediately the rewards for that. And now, in the next couple of years, Apple will have to give some of that back with longer replacement cycles, very simply.
So, Pierre, we've seen a slew of downgrades. I have a chart here in my GTV library showing how the average target price has dropped. The blue line is the average 12-month target price. The white line, Apple shares. You've now upgraded to neutral. Do you think this is as bad as it gets, or it only gets better from here?
So I'm going to be a bit cheeky and give you a balanced response. So on an absolute basis, things could get worse, definitely. How could I call, what's going to happen with the Chinese consumer in the next 6 months? Nobody can really call that. There is a lot of uncertainty. Now, if you look at it specifically for Apple, if you ask me about risks specific to Apple, I do indeed think it's as bad as it can get. Because Apple is an early cycle business. It's a discretionary consumer business, which means that if there is an economic slowdown, they are the first to get hit, and they've just been hit. And then my concern about replacement is exactly what the company talked about last night. So these things are behind us. So for what is specific to Apple, I don't see significant risk ahead. Now, of course, if you tell me China is going to continue to deteriorate, then Apple is going to suffer. But Apple is not going to suffer just by themselves. They are going to suffer with everybody else.
Let's talk about the stock GTV chart on the Bloomberg library showing this fall of Apple. More than $450 billion of market cap lost since their October peak. What's next for the stock? And more importantly, are we entering attractive valuation levels?
Mm-hmm. So from a valuation standpoint, my 2020 earnings expectations have not really changed overnight, and they are like in the $14 region. So the stock is trading close to 10 times that. The company still has $130 billion of net cash on their balance sheet and aim to return that to shareholders. So yes, the stock is entering an attractive valuation territory. Now, of course, when the core business of a company is in free fall, investors usually don't look at valuation much. So it's probably too early to start thinking about whether Apple is a buy here. But in terms of valuation, unless you believe there is something significantly worse than just people keeping their iPhone longer, Apple is becoming attractively valued. You have to remember that the non-iPhone business of Apple is growing as we speak, almost 20% a year. So that's still a very healthy business. People who buy an iPhone on the first-hand market is a group of people that is not growing anymore. This population is not growing anymore. But iPhone users with the second-hand market is still growing. And that's a driver of the service business. And then new devices like the watch are still very small in the broader picture for Apple, but are doing extremely well.
All right, Pierre Farragut, New Street Research Global Head of Tech. We'll be watching to see if your neutral pans out. I want to head back to Sydney, where Heidi is standing by now to take a look at the impact, a deeper dive on the impact on Apple suppliers. Heidi, what are you seeing?
Yeah, Emily, as we saw yesterday, we saw some of the South Korean as well as Taiwanese suppliers reacting pretty negatively. There's an argument that a lot of that was already priced in, given that some of these stocks had fallen between 50 to 70% over the past year on these headwinds and concerns about slowing shipments. I want to bring out Garfield Reynolds, who's taking, as you say, a deeper look at really across, a number of these Asian suppliers. I suppose the only reprieve yesterday was that Japanese markets were actually closed. Japan comes back online. There's going to be some pent-up selling.
Yeah, there's going to be pent-up selling in Japan for a lot of reasons. Just taking a look initially at the Apple impact. And for Japan, that's not just the suppliers themselves. We'll take a look at those in a second, but also just the broader market. Japanese index futures are indicating about a 3% down open, and that's because of what's been going on more broadly, both with US shares and also with the yen, which has gained. But if we take a look, we've got a GTV chart ready for you at what's been going on with those Asian suppliers, as we mentioned. And you can see how, so we've got Apple itself and Hon Hai, which is a Taiwanese company that's the most Apple exposed in the supply chain, and then the most exposed in terms of revenue and the quantified relationship in Japan, which is Sharp. And you can see how the Asian suppliers, they already started falling some time ago, and Apple, in fact, would need to fall further to catch up to them. So I think you could expect Sharp to drop quite strongly today as it catches down to everything else. But you have to think there's at least a chance that the Asian suppliers can consolidate. And in fact, anybody who owns Apple probably needs to hope that's the case, because as you were mentioning, they've been a very good bellwether for what actually ended up happening with Apple, because they are reacting sort of beforehand to what they're seeing. They probably get the best information about Apple's outlook because they're talking with the company and they're supplying the company. And that's shown up in what's been going on for the last 3-6 months.
Yeah,
in
which
Asia.
is why they've tended to sell on the rumour, and now we actually know what the facts are. It's interesting that the broader declines in Asia yesterday were actually fairly muted compared to what we then saw overnight in the US. But you mentioned we had the flash crash in Japan, and Apple was actually one of the factors that we kind of talked about as being maybe a reason other than algorithms and the timing. But does where we go from now really depend on the question of, is this a China story, is this a doom and gloom macro story, or is it Apple specific?
Well, I mean, Apple is important in and of itself, its direct effects, but the real problem is what it's doing to the zeitgeist. Every day, it seems, we get fresh pain from a major global supplier or major global bellwether sort of a company. And overnight we had Delta as well, which speaks more directly to the American economy, but also to the global economy. And that's it. It's becoming an economy story and a risk appetite story. And we've got another chart to show you. We talked about the flash crash. One of the pairs that was at the absolute epicenter of that crash was the Aussie yen, and the Aussie yen has often been used as a classic risk proxy. So it's tended to track Asian stocks and world stocks as well, but especially Asian stocks. And you can see on the chart how both the Aussie yen and Asian stocks peaked some time back. Then they started to come down. Asian stocks have been a bit sticky, maybe because of China hopes, maybe, but for whatever reason. Meanwhile, the Aussie yen keeps crashing, and it really crashed yesterday. And that signals the potential for some serious declines going forward in equities.
All right, starting the year as we intend to carry on with more volatility, it seems. Garfield Reynolds here in Sydney. Lots more to come here on Bloomberg.
Tim Cook's letter on Apple's woes blamed an unforeseen slowdown in iPhone demand in China, saying, quote, "While we anticipated some challenges in key emerging markets, we did not foresee the magnitude of the economic deceleration, particularly in Greater China." But in reality, Apple has been struggling to grow its business in China for years and losing market share there to local rivals like Huawei and Oppo. To dig into what is happening on the ground to Apple in China, I want to bring in Bloomberg Opinion, Shira Ovide in New York. And from Bozeman, Montana, we've got Ben Harburg, managing partner of MSA Capital, a venture capital firm based in Beijing that has over $1 billion under management. So, Ben, I want to start with you, since you are based in Beijing. I'm just curious, on the ground, are you hearing anecdotally from Chinese consumers that they don't want to buy an iPhone because it's American, or are the phones just too expensive?
No, I think it's unfair to try to tie this to the trade war directly. The sentiment in China has long been that Apple had priced itself out of the market with a number of very strong local competitors like Huawei, Vivo, Oppo, Xiaomi, whose phones were on par, if not better, and cost sometimes half to a fourth of the price of Apple. And so, no, I've certainly not seen any negative sentiment towards American products and Apple being caught up in that kind of a trade war mentality.
So, given that, Shira, you make an excellent point in your latest column that Apple and Tim Cook should have seen this coming. Why didn't they?
I don't know. I think that's the question that investors should be asking Apple management right now. Look, it's possible that in the 2 months since Apple last reported earnings and gave their earnings forecast, that economic conditions in China have deteriorated more than Apple anticipated. That's certainly possible. But it is also true that smartphone sales overall in China have been declining since the middle of 2017. The economic growth there has been slowing for some time. The trade war persisted for much of 2018. And everything from Apple about China and the rest of its business until right this very moment, until the Wednesday letter, was that everything is going great in China. So all of these trends, both in China and in the changes in smartphone buying behavior in general across the world, Apple never talked about those trends, and Apple never readied investors for the possibility of weakness in their iPhone business, again, until it was glaringly obvious to the company and everybody else.
Now, I want to take a bigger picture look because I have a chart here in the Bloomberg that shows the relationship between U.S. tech stocks and China tech stocks. The blue is U.S., the white is China, and the green shows a measure of correlation, which shows that over the last several months, actually, the fate of U.S. and China tech stocks has been increasingly correlated. How closely tied, Ben, do you think are the fortunes of U.S. tech and China tech?
I think they're separate, and I think that China is very much now looking at the rest of the world when it thinks about building businesses. Even in the smartphone market, I think Apple has not done a good job to compete with rivals like Huawei and Xiaomi as they attack new global markets like Indonesia, MENA, Southeast Asia, where those operators offer phones at a half, even a tenth of a price of Apple, while offering similar tech specs. And so Apple's not done a good job to address kind of that next billion consumers. And I think Chinese companies more and more frequently now, and you see that with both the kind of private tech companies as well as the public ones, the Tencents and the Alibabas of the world are very much going global, and it's everything ex-USA. And so while I think there is investor sentiment that psychologically kind of ties the two together, I think China is targeting a part of the world that is still very underpenetrated from a technology perspective and offers a lot more upside rather than focusing on mature markets like the United States and Western Europe.
Now, Shira, in your column, you talk about how Tim Cook needs better ideas, and you focus on actually my favorite line from the shareholder letter, which is, we can't change macroeconomic conditions, but we are undertaking and accelerating other initiatives to improve our results. One such initiative is making it simple to trade in a phone at our stores, finance the purchase over time, and get help transferring data from the current to the new phone. Well, that sounds great, but is that the best you got?
Yeah, I agree that was the only specific kind of strategic change that Tim Cook mentioned, and it was pretty lame, to be honest. That it is true that the most important market for Apple and other smartphone makers is the replacement market. People who already own iPhones are by far buying the vast majority of new iPhones, and so Apple has an incentive to make it easier for people, easier and more appealing for people to upgrade older iPhone devices to new models. But the fact is that Apple already offers a replacement iPhone purchase program. So do a lot of smartphone carriers, both in the United States and outside of the United States. And it hasn't changed the trends in the replacement rate, which is the smartphone market is saturated. People are holding on to existing devices for longer and longer, as your guest Pierre said earlier, and that means that new iPhone sales are under pressure, and Tim Cook offering an idea that, again, it and its partners already are doing is not very encouraging.
All right, Shira Ovide, Bloomberg Opinion. Always appreciate you sharing your opinions with us. Ben Harburg of MSA Capital, thank you both. Still ahead, Apple faces new hurdles and challenges as demand slows down. Will CEO Tim Cook be able to save it or sink with it? This is Bloomberg. In 2018, Tim Cook celebrated his 7th anniversary as Apple CEO. Now, his 8th year is off to a rocky start. And while Cook has navigated several obstacles in his tenure, including tariffs and the Trump administration, the weakening iPhone demand could be his toughest test yet. Here to discuss, Bloomberg's Tom Giles. Tim Cook really built the China market for Apple. He built the supply chain. Steve Jobs never visited never visited China once. Tim Cook has gone there several times, and he's really cultivated Apple's relationship with the Chinese government. How big a test is this for him?
Well, I think you hit the nail on the head. This is a very big test. This is the world's most populous country. This is the country that has the most smartphones. This is, this is crucial to their growth, right? And, they just priced the device wrongly in that market, especially when you have the likes of Huawei and Oppo and Vivo and these other competitors that are putting their own devices into the market, and they've got a lot of the comparable features. So you really have to make the iPhone super special and price it right in order to compete with these other devices, and that just didn't happen here. So going into this last quarter, they thought they saw a lot of growth. They had 16% growth. He said it on the conference call. They had every reason. They had a lot of reason for optimism, right? But I just don't think, I think they fail to foresee exactly how sluggish the demand, whether it's down to the trade war, whether it's down to the economic slowing, whether it's down to competition. China's become a real sore subject for Apple.
He's been making great effort to engage with Washington. He's been to the White House several times. Does this fall on him?
Well, I think there's a lot of things that at work. I mean, I do think the trade war does have something to do with it. I do think that he has control over how they compete in that market, and so did he price it correctly? I think also it's down to what's their next big thing, right? I mean, that's the big question surrounding Tim Cook at the moment. Is it AR? Is it autonomous vehicles? Is it acquisitions? They have a lot of money. And now Tim Cook has to ask those really hard questions. You can no longer rely on this smartphone that accounts for 2/3 of revenue. They do need some new ideas.
They've never made a huge acquisition. Beats was the biggest, about $3 billion, which was under Tim Cook. But if services are the next big thing, that depends on the iPhone.
It does. Well, absolutely, because that's what people. I mean, they use services on the watch and the iPad as well, and on the Mac. But you're right, absolutely on the iPhone.
All right, Tom Giles, lots to discuss. We're going to continue talking about this for the next weeks and months, I'm sure. Tom Giles, Bloomberg Tech. Thank you so much. That does it for this edition, this special edition of Bloomberg Technology. We are live streaming on Twitter. You can check us out at Technology and follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.